How to invest like Warren Buffett. Okay, so Warren Buffett is unarguably one of the greatest investors of all time. He's been called the Oracle of Omaha, the Sage of Nebraska, and from a young age he knew he would be rich. That prophecy did come true, and today he's worth about $80 billion. At a young age, Warren would buy 6 packs of Coca-Cola for a quarter and sell each for a nickel. He also sold the newspapers and magazines door to door. He collected and sold golf balls, and in fact, he even got other kids from his neighborhood to collect and sell golf balls as well. He had all sorts of small ventures. He grew up knowing he wants to make money. He said he loved doing business, and armed with about $114 in which he had saved in 1942, he bought his first stock called Cities and Services. He said he went all in and made a good return. And I think it's safe to say the kid had a bright future, and together with his partner Charlie Munger, they have created one of the largest corporations in the world. So luckily for you and I, Warren has left clues as to how he became so successful. So in this video, I'm going to share 10 principles for investing that anyone can use to become rich. So whenever Warren goes hunting for companies and businesses to buy, he looks at the management team first, whether they're talented and competent, and if so, he buys shares in the business. One of his policies is not to buy 100% of a company or a business, but to own an uncontrolling but substantial portion of the business. After all, when you own hundreds of companies, who has time to run them all, right? Warren has invested in a vast amount of businesses over the years, ranging from lollipops to jet airplanes. Some of the businesses measured by earnings enjoy terrific economics, producing profits that run from 25% after tax to far more than 100%. Others generate good returns in the area of 12% to 20%. However, a few of the businesses he has invested in have very poor returns, a mistake he attributes to missteps he made in capital allocation and evaluation of the economic dynamics of the companies and the industries in which it operated in. On the other hand, these missteps he attributes to the poor returns are usually small blunders in the overall balance sheet. So keep your mistakes to a minimum and don't be shy about taking calculated risk. Never gamble with your money, but invest in a venture that has a good chance of succeeding. Focus on the future productivity of the assets you are considering investing in. If you don't feel comfortable making a rough estimate of the asset's future earnings, just forget it and move on. No one has the ability to evaluate every investment possibility, but omniscience isn't necessary. You only need to understand the actions you are undertaking. Warren Buffett says, you don't need to be an expert in order to achieve satisfactory investment returns. However, you must recognize your limitations and follow a course certain to work reasonably well. Keep things simple and don't swing for the fence. When promised quick profits, respond with a quick no. When investing, if you focus on the prospective price change of a contemplated purchase, you are speculating. There is nothing improper about this though, but you should be skeptical of people who claim that they can accurately predict the future price of a stock with no solid evidence to prove so. Half of all coin flippers will win their first toss, but none of those winners are assured of profits if they continue to play the game. The fact that a given asset has appreciated in the recent past is never a reason to buy it. Don't keep watch of your stocks daily. In Warren's annual report, he wrote, "With my 2 small investments, I thought only of what the properties would produce and cared not at all about their daily valuations. Games are won by players who focus on the playing field, not by those whose eyes are glued to the scoreboard. If you can enjoy Saturdays and Sundays without looking at the scoreboard, give it a try on the weekdays. Forming macro opinions or listening to the macro or market predictions of others is a waste of time. Indeed, it is dangerous because it may blur your vision of the facts that are truly important, such as the annual report of the business, future plans if they have any, the management team, are they competent or not, such things." Emotions aside, owners of stocks, however, too often let their emotions and irrational behaviors of their fellow owners cause them to behave irrationally as well, because there is so much chatter about markets, the economy, interest rates, price behaviors of stocks, etc., that you are overwhelmed and end up making irrational decisions. Some investors believe it is important to listen to pundits, and worse yet, important to consider acting upon their comments. People too often become frantic when they hear chit-chat about an inside trade or deal they just can't miss on. And worst of all, they act on this false information without putting any time to research whether this information holds any merit or not. Never take investing advice from someone who doesn't have a clue about investing. The point is, Do not make life-changing decisions predicated on tips or rumors you might have overheard. Do not take investing advice from friends and people who know nothing about investing or the stock market. If your best friend or coworker is advising you to invest in a particular stock or business, don't just jump into it. Critically analyze the information he or she is providing you. Ask them where they got the information from and who gave it to them. It might actually be a good tip, but first do your own due diligence before investing. A flash crash or some other extreme market fluctuation is really bad for your average Joe, but it seldom hurts a seasoned investor because while other people are seeing red flags and smoke everywhere, all a seasoned investor can see is opportunity. Indeed, troubling markets can be a great opportunity to the true investor if he has cash available. So always have a reserve for such moments. Warren wrote, "A climate of fear is your friend when investing. A euphoric world is your enemy. Never buy at a premium, always have cash laying around for such times, because the market will bounce back, it always does." When Warren and Charlie buy stocks, they think of it as a portion of the business. Their analysis is very similar to that which they use in buying entire businesses. They first have to decide whether they can sensibly estimate an earning range for a 5-year period or more, and if the answer is yes, they will buy the stock or business if it's selling at a reasonable price in relation to the bottom boundary of their estimates. If, however, they lack the ability to estimate future earnings, they simply move on to other prospects. Warren Buffett said that in the 54 years he and Charlie have worked together, they have never forgone an attractive purchase because of the macro or political environment or the views of other people. In fact, these subjects never come up when they make decisions. So don't let small circumstantial issues hinder you from making a good investment. Most investors, of course, have not made the study of business prospects a priority in their lives. If wise, they will conclude that they do not know enough about specific businesses to predict their future earning power. But Warren Buffett says, "I have good news for the non-professionals. The typical investor does not need this skill. In aggregate, American businesses have done wonderful over time and will continue to do so, though most assured in unpredictable fits and starts." In the 20th century, the Dow Jones Industrial Index advanced from 66 to 11,500, paying a rising stream of dividends to boot. The 21st century will witness further gains, almost certain to be substantial. Warren says the goal of the non-professional should not be to pick winners. Neither he nor his helpers can do that. Rather, it should be to own a cross-section of business that in aggregate are bound to do well. A low-cost S&P 500 index fund will achieve this goal. It is no secret that Warren plans to give away most of his fortune to charity upon his passing. In his will, he said, "My advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I suggest Vanguards," he said. "I believe the trust's long-term result from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers." So in conclusion, these are just 10 things that Warren Buffett and seasoned investors use to become rich, and by employing these habits, you'll be much better equipped to become wealthy yourself. Thank you for watching, guys, and I guess I'll see you on the next one. Cheers.